Welcome to our session on building a diversified portfolio with Dr. Microlearning. In this lecture, we'll walk through practical steps so you can balance growth, manage risk, and rebalance strategically over time. Think of this as a blueprint that covers asset allocation, risk controls, long-term focus, and rebalancing techniques to keep your investments aligned with goals and changing market conditions. Diversification works by blending assets that don't move together, which smooths returns over time. When stocks zig, bonds may zag, reducing overall volatility and keeping expected returns more stable. That mix helps improve risk-adjusted performance and, just as importantly, reduces emotional stress during market swings, giving investors better outcomes and more peace of mind in turbulent periods. Let's look at the core asset classes and how they behave. Equities drive long-term growth, but are sensitive to growth and liquidity shocks. Bonds supply stability and income while offsetting equity volatility, though they react to interest rates and inflation. Cash offers liquidity and optionality, but loses real value in high inflation, and real assets hedge rising prices. Understanding these responses helps you position assets for different economic drivers. Asset allocation should reflect life stage and risk capacity. Young earners with long horizons can favor growth, often holding a higher equity share to tolerate volatility. Pre-retirees typically move toward a balanced mix to lower human capital risk and preserve gains. Retirees prioritize income and capital preservation, shifting to more fixed income and cash to stabilize withdrawals and protect purchasing power. Sector and market cap diversification limit concentration risk and capture varying growth opportunities. Avoid putting more than a set percentage in any single sector to reduce exposure to earnings cycle traps, while including small, mid, and large caps to harvest different risk premia. This broad approach helps smooth sector-specific downturns and improves the portfolio's risk-return profile over time. A simple geographic split, 40% home market, 40% developed ex-home, and 20% emerging, aims to capture global growth while tempering home bias. Rotating leadership across regions and diversifying currency and demographic exposure helps balance growth potential with risk mitigation, so you're not overly dependent on a single country or market for long-term returns. Diversifying the fixed income sleeve means mixing treasuries for safety, corporates for yield, and munis for tax efficiency, while balancing duration to control rate sensitivity. Short duration bonds reduce sensitivity to rate moves. Long duration can offer higher yields, and international bonds add currency and market diversification. Together, these choices enhance stability and optimize risk-adjusted returns within the fixed income allocation. Automated solutions like target date and balanced ETFs use auto-rebalance mechanisms to maintain a chosen risk profile without day-to-day micromanagement. They offer low fees, broad diversification across regions and sectors, and dynamic reallocation features that adjust exposures as markets shift, making them ideal for hands-off investors who want a simple set-and-forget strategy focused on long-term goals. Building a portfolio can be automated with robo-advisors or hands-on with DIY broker platforms. Robo-advisors assess risk, deliver bespoke allocations, and handle rebalancing and tax loss harvesting automatically. DIY investors gain granular control to layer factor tilts, ESG preferences, or thematic bets, but take on execution and monitoring responsibilities. Both paths can work depending on your time, skills, and desire for control. Strategic rebalancing keeps the portfolio close to its policy mix through disciplined review and action. Check weights at least twice a year and trigger adjustments when any holding drifts more than 5% from target. The discipline play is to trim overweight winners and buy underweight laggards, restoring long-term stability and locking in gains while managing portfolio risk consistently. Tactical implementation focuses on cost, taxes, and asset location to maximize after-tax returns. Favor low-cost index funds to minimize fees, harvest losses in taxable accounts to offset gains, and place high-yield or tax-inefficient assets inside retirement accounts for sheltering. Small fee savings compound meaningfully over time, so attention to costs and tax-smart moves can add years to retirement income. The four-step process to build a diversified portfolio starts with defining goals and assessing risk, then selecting and implementing a broad, low-cost stock-bond mix. Next, automate contributions and periodic rebalancing to maintain targets, and finally execute with patience so compounding works in your favor. Start small, stay consistent, and let disciplined implementation drive long-term growth and financial resilience.